Hello, my name is Taylor Wilkins and I'm part of the BYU BlackRock Externship team. I'd like to begin by thanking you for giving me this opportunity to present on the hedge fund industry. It is my current understanding that of your $1 billion investment fund, that approximately 60% is allocated to the MSCI World Index, and the remaining 40% to the Barclays Bond Index. Through this presentation, I would like to show you how an investment into the hedge fund industry not only add to your returns of your overall portfolio, but also mitigate much of its risk. I'd like to do this in a series of steps, first beginning by explaining what is a hedge fund, followed by giving some background on the hedge fund industry, where it's been, where it currently is, and what the outlook is going forward. I'd like to follow that up by discussing the main strategies within the hedge fund industry. I'd also like to provide an array of analytics, looking at the different strategies as well as the overall hedge fund industry from various angles. Finally, I'd like to give you a detailed recommendation on the amount of investment I think you should invest within the hedge fund industry, as well as the allocation to each of the individual strategies. I'd like to sum that all up by showing how, by implementing my recommendation, how that can help your current portfolio not only increase in returns, but also decrease in volatility. Beginning with discussing what a hedge fund is, the word hedging is the practice of reducing risk. Something hedge funds are already known for is their excessive returns that they have, but also something that they strive to do is mitigate much of the risk at the same time. Because of this, they are known as an aggressively managed portfolio of investments. This is because they use different strategies such as leverage, long and short strategies, as well as derivative positions. Because of these advanced strategies that they implement, they are only accessible to accredited investors. This means someone who has a net worth of $1 million or more, as well as annual income of $200,000 for at least 2 years. Hedge funds have been highly unregulated historically. This has allowed them to have extremely high returns annually. They're also different in their fee structure. They have what's commonly referred to as the 2 and 20. The 2 refers to their management fee. All of their assets that they manage, they charge a 2% on those assets. The 20 refers to the profit fee. Any profits that they have, they charge a 20% profit fee. Now, as you can see from the graph in the top right corner, the hedge fund index is displayed there as the bolded gold graph in the center. As you can see, it has performed significantly well since for the past 10 years. Also, I'd like to note that it has performed better than the Barclays Bond Index. I would also like to point out that not only has it performed better than bonds, but its volatility has been much less than that of the MSCI World Index. And like I stated earlier, that is something that is characterized of main characteristic of hedge funds is that they have better returns than the bond index, while also mitigating much of the risk through less volatility, which we'll discuss in detail later. Now, I'd like to discuss the hedge fund industry. A quick background is that the hedge fund industry really had its start in the 1950s with a man named Alfred Jones who established the first hedge fund, and he did this by not only implementing long strategies but also short strategies as well. Long strategies is, in its simplest form, is buying a security in hopes that it appreciates, so buy low and sell high. Shorting is buying high and selling low, or in other words, hoping for a depreciation factor. Now this is why hedge funds do well in up markets as well as down markets, because they can capitalize on the upward trends in the markets as well as the downward trends as well. As you can see, compared to the S&P 500, the hedge fund industry has had 1,000% in cumulative growth since 1990, and that compares to 300% in the S&P 500. Annualized, the hedge fund industry has had 11% in growth, and that compares to approximately 6.3% in the S&P 500. As you can see by the graph on the right, that growth in AUM in the hedge fund industry has increased dramatically since 2000, reaching a peak in 2007, thereafter taking a dip due to the financial crisis, but actually has rebounded and is at its highest rates ever. Much of this is led by the investment by institutional investors. Institutional investors have historically invested a significant amount into the bond markets, but because really returns in the bond markets are so minimal due to low interest rates, they've sought alternative forms of investment, particularly hedge funds. Something important to note is that 5 years ago, approximately 60% of the investment within the hedge fund industry was by high net worth individuals. That is now reversed, where 60% of the investment in the hedge fund industry is by institutional investors, thus highlighting their shift and their large AUM within the industry. Also important to note is that approximately 10% of institutional investors' allocation is in the hedge fund industry, and that allocation is expected to double by 2016. Also, another important trend within the industry is the increased regulation that we will see going forward, particularly with the Dodd-Frank Act, followed by the Foreign Account Tax Compliance Act, the FATCA, and then finally the Alternative Investment Fund Manager Directive, the AIFMD. Now, these regulations, although will take some time to be implemented, but when they are, we expect to see returns diminish slightly. Alright, well, I'd now like to move on to the next slide and discuss the different strategies within a hedge fund. There are 4 main strategies I'd like to discuss: the global macro strategy, relative value strategy, equity hedge, and event driven. First, the global macro strategy. The global macro strategy really takes advantage of global macroeconomic trends throughout the world, as well as local trends as well. Managers who implement this strategy take positions in equity markets, fixed income, currency, and commodity markets, and base their investments off of macroeconomic trends that are happening within the designated region that they invest within. Now, this strategy has actually been extremely successful since its implementation. In the last 10 years, they've had 6.3% annualized returns, and that has amounted to a 5.7% alpha to the S&P 500. This has also amounted to a 0.98 Sharpe ratio, again for the last 10 years. Sharpe ratio basically shows the amount of return for each unit of risk. By having a 0.98 Sharpe ratio shows that they are having exceedingly high returns while also mitigating much risk. Thus, the higher the Sharpe ratio, the better. Something important to note with the global macro strategy is that many of the factors that determined the trends and the events within this strategy have changed significantly, particularly government's involvement within the economy. Since the downturn during the financial crisis, many governments have taken an increased role in managing the economy, and this has made it difficult for managers within the global macro strategy to really exploit trends and events happening, because government has made many unpredicted and unprecedented moves. I'd now like to discuss the relative value strategy. Relative value takes advantage of price discrepancies between related securities. This is a strategy that employs much mathematical, technical, and fundamental analysis. It is also known as a market neutral strategy, in the sense that movements within the market have little impact on the relative value strategy because it is focused primarily on price discrepancies. Now, in comparison to the global macro, it has had a 6.7% annualized return for the past 10 years, and that amounts to a 3.5% alpha to the S&P, as well as a 0.64 Sharpe ratio, again for the last 10 years. The next strategy is the equity hedge. The equity hedge is the traditional hedge fund strategy, which employs both the long and the short uh, strategies. Now, as I discussed this a little bit earlier, buying long is the notion of buying a security in hopes of appreciation, or the stock going up, buying low and selling high. Whereas short selling is buying high and selling low, or in other words, hoping for depreciation in the asset. And this is really helps you to take advantage of upturns as well as downturns in the market. This strategy utilizes fundamental analysis, market movements, trends, as well as inconsistencies when picking stocks in the markets. This strategy for the past 10 years has had 5.8% annualized returns, as well as 1.8% alpha to the S&P 500 and a 0.42 Sharpe ratio for the last 10 years. Finally, the event-driven strategy. The event-driven strategy really focuses on events that happen within the corporate environment. Examples of this are consolidations, mergers and acquisitions, recapitalizations, bankruptcies, and liquidations. Managers who employ this strategy are really looking for events that are happening within the corporate environment, such as those I just mentioned, and take advantage of those events by making investments around them. This strategy has actually been the most successful for the past 10 years on an annualized basis, amounting to 8.2% annualized returns, with a 4.1% alpha to the S&P, as well as a 0.62 Sharpe ratio. So I hope this gives a good overview of the different strategies within the hedge fund industry. I'd now like to move on and discuss many of the analytics that are involved within these strategies and discuss those in detail. I'd like to begin here on this slide by discussing the returns and the volatility for these various strategies which we've just discussed. Now, in terms of cumulative returns, as you can see, the equity hedge has actually been the best performer since inception, amounting to approximately 1,443% cumulatively. One thing I'd like to note is the inception here is the year 1990, and that is when the HFRI company began recording these hedge fund strategy returns year over year. Now moving on to the annualized returns, following cumulative returns, the equity hedge has been the top performer with 12.6% annualized return since inception, and this is followed by relative value, which has actually been the top performer in annualized returns in the recent years. As you can see, in the last 5 years it had approximately 5% annualized return, and in the last 3 years it's amounted to 7.3%. Now, in terms of volatility, relative value has had the lowest levels of volatility since inception, with approximately 9% since inception. However, in the last few years, the global macro strategy has had the lowest percent of volatility represented there in the last 3 years, with 5% of volatility. Now moving on to the next slide here, I'd like to discuss the correlation, beta, and alpha to the S&P 500. As you can see in the correlation heat map, that the macro strategy has consistently held the lowest levels of correlation to the S&P 500. As you can see, since inception with a 0.33 correlation, and in the last 3 years with a 0.41. Moving on to beta to the S&P 500, similar to correlation, macro has actually held the lowest levels of beta to the S&P 500 since inception with a 0.17, and in the last 3 years a 0.13. Also, I'd like to note that the relative value strategy has also held a low level of beta to the S&P 500 with a 0.15 since inception and a 0.17 in the last 3 years. Finally, with alpha, and as you can see, this is a reverse of the correlation in beta, which we would somewhat expect. since inception, macro has held the highest levels of alpha, as you can see there, with 10.8% approximately alpha for the macro strategy to the S&P 500. However, recently, meaning in the last 3 years, the relative value has held a higher alpha to the S&P 500, actually the only one which has had a positive alpha with 0.13%. So moving on to this next slide here, as you can see, this will discuss the Sharpe ratio, Sortino, and information ratios within the several strategies here. So begin with the Sharpe ratio. As I mentioned earlier, the Sharpe ratio shows the amount of return that each strategy is receiving for each unit of risk. The risk factor that was used in this analysis is the volatility of each of these strategies. So in the table here of the Sharpe ratios, as you can see that the relative value has held the highest Sharpe ratio not only since inception, again since 1990, but also in the last 3 years, with a Sharpe ratio of 1.41, which makes it, that is extremely impressive. Again, the Sharpe ratio is it shows the efficiency of the strategy, meaning that it is having very high returns while also mitigating much risk. Moving on to the Sortino ratio. The Sortino ratio is an adaptation of the Sharpe ratio in the fact that it is the Sharpe ratio in down markets. Now this really eliminates the discrimination between up and down volatility. As you can see, and as was similar with the Sharpe ratio, the relative value index has held the highest Sortino ratio for the last 5 years and for the last 3 years as well, with 1.58 for the last 5 years and 2.31 for the last 3 years. Finally, the last ratio that you see on this slide is the information ratio. The information ratio measures a portfolio's ability to generate excess returns relative to a benchmark. In this case, the benchmark that was used was the S&P 500. Similar to the other ratios, the relative value has held the highest information ratio in the past 3 years, in this case with a negative 1.1 information ratio. So now that we have discussed what a hedge fund is, the industry, as well as various strategies, and also many analytics that are involved with the strategies, I'd like to sum up the analytics by discussing what is known as the efficient frontier. Now, a portfolio is considered efficient if it has the highest return for the lowest amount of volatility. The efficient frontier was introduced by a man named Harry Markowitz, who actually went on to win the Nobel Prize in Economic Sciences in 1990 for his findings. As you can see in the chart in the top right corner, the efficient frontier is the line, the curved line, which represents the portfolios that have the highest return for the lowest amount of standard deviation or volatility. As you can see, the best portfolio is the portfolio which is tangent, which is the portfolio which sits on the efficient frontier, which is tangent to the capital allocation line, as represented in this chart by the red dot. The capital allocation line has its y-intercept as the risk-free rate. By using the portfolio on the efficient frontier that is tangent to the capital allocation line, you will be achieving the highest rate of return for the lowest amount of volatility. Now, I have run this analysis for the hedge fund strategies which we have discussed for different time periods. The first is since inception, or since 1990, the best or the most efficient strategy was the global macro strategy. Had you implemented this strategy within your portfolio since 1990, you would have had an annualized return of 6.38% with a volatility of 9.08% and a Sharpe ratio of 0.7. In the last 15 years, the efficient frontier shows that the event-driven strategy would be the best allocation, giving a 5.02 annualized return for the past 15 years, a 9.3% annualized volatility, and a 0.54 Sharpe ratio. This follows for the past 10 years would have been the event-driven strategy again with 6.4 annualized return, 9.2 annualized volatility, and a 0.7 Sharpe ratio. And then for the last 5 years, this is in tangent with many of the analytics that we discussed prior. The relative value strategy has been the highest, the most efficient strategy with 2.14% in returns, with a 9.07% annualized volatility, which is amounted to a 0.24 Sharpe ratio. I'd now like to sum this up by giving you my overall recommendation. This takes into account all the analytics which we have discussed, particularly the Sharpe ratio and the efficient frontier. What you will find is that an investment into the hedge fund industry based on my recommendation and allocation to each strategy will not only increase your overall returns of your portfolio, but also decrease the volatility or risk aspect, thereby increasing the total Sharpe ratio for your portfolio of investments. So with my recommendation for your 1 billion fund considering an investment into the hedge fund industry, I recommend that you invest 100 million, which represents approximately 10% of your portfolio. As you've outlined to me, currently 60% of your portfolio is within the MSCI World Index and 40% is within the Barclays Bond Index. What I recommend is that you decrease those amounts to 54% into the MSCI World Index and 36% into the Barclays Bond Index, leaving 10% for the hedge fund industry. Within the 10%, these are the allocations that I recommend, as you can see labeled in the bottom left corner chart. 34 million to the relative value strategy, or approximately 3.4%. 24 million to the event-driven strategy, or 2.42%. 22 million to the macro strategy, or 2.16%. And 20 million to the equity hedge strategy, or 2.03%. Now, like I mentioned earlier, these are based on data that we have already discussed, particularly the efficient frontier, the Sharpe ratio, and other analytics, as well as the outlook going forward, which I think is very instrumental in looking at these strategies. Now, the most important part of my recommendation here is the effect that this will have upon your portfolio. If you implement these allocations that I have outlined here, it will result in a 6.31% annualized return. This is approximately 9.27% more than you would be receiving from your current portfolio of 60% MSCI and 40% in the bond index. This will also result in a 9.15% volatility, which will be a 6.34% approximately decrease from your current portfolio. Finally, this will result in a Sharpe ratio of 0.69, which will represent a 16% increase from your current or previous portfolio. I believe that this recommendation will provide you with the highest level of return and the lowest level of volatility within your portfolio. I am glad for the time that you have given me to present this analysis to you and hope that you will follow my recommendation. Thank you again for your time.